The tentative debt ceiling deal reached, many investors will probably turn their attention to what the Fed will do at its next meeting. That starts just 2 weeks from today. For more, we want to bring in Mohamed El-Erian, the chief economic advisor at Allianz and the president of Queens College, Cambridge. And Mohamed, are you considering this debt deal at this point almost a done deal?
Look, my working assumption from the beginning was that we will somehow sort it out. And it seems like it's being sorted out. I mean, I would very much echo what Josh Bolton just said. It is absolutely necessary for this agreement to get through Congress if we are to avoid shooting ourselves in the foot again.
All right, if that's the case, let's turn our attention to the next issue at hand, and I guess that has to be the Fed meeting in 2 weeks. Steve Leisman came on in the last hour and said that he thinks the idea of a pause is more likely to be off the table at this point, just because the data has not been anything that the Fed could say, OK, here's a reason why we should pause.
Yeah, so I put a piece out earlier this morning saying that if you take the Fed at its word, which is that they are excessively data dependent, then given the data, that they would find it hard to pause. Now, between now and the next meeting, we have a CPI report and we have a jobs report, so this could change. The problem is that because the Fed is so data dependent, even the Fed itself is all over the map. You have those who think we should pause. You have those who think we should skip, meaning you pause now, but you hike at the next one. You have those who think we should hike, and you even have one person who thinks that we shouldn't have hiked. So, this is the problem when you lack a strategic underpinning, is that the data can swing you around. And with that, we swing the 2-year and all over the place.
We've had a number of people who have come on and said, if you're not looking at the banks, if you're not looking at real estate, if you're not looking at the housing market, well, then things look great. How much of an impact do those arenas, though, have on the overall economy?
So I think it is necessary for certain sectors to deflate. And that is because inflation has migrated from the goods sector to the service sector. And the service sector is less sensitive to interest rates. So the bits in the goods sector, housing being the perfect example, that are very sensitive to interest rates are going to get beaten up. And that's what has happened. We also have private markets that are slower moving, but you've got over $1 trillion of commercial real estate that has to be refinanced. So I do think there are bits that are feeling the impact of the interest rate. Now, the one that I'm not ready to assume away is bank credit. We simply don't know at this point what's going to happen to bank credit. And it's important to keep an open mind on this.
OK, so what would you be telling people to do at this point? We've heard other people say that the markets seem frothy, especially if you're looking at some of the technology stocks that are really riding AI. On the other hand, you've got NVIDIA turning in some incredibly strong numbers and even stronger expectations about what they can deliver in the future.
So we've seen the emergence of what I call all-weather stocks, stocks that have one or both of these attributes. They're seen to be riding a massive secular wave, multi-year. NVIDIA is an example of that. Or alternatively, they're seen as not being sensitive to economic and financial fluctuation. Think of Microsoft as an example of that. And those stocks have basically, as you heard earlier, done all the heavy lifting for the indices. And that's why the Nasdaq's outperforming. That's why the S&P is in positive territory. And that's why the Dow has struggled so much. So the bet so far has been on these handful of stocks. And that makes sense. I worry more about the other stocks that are sensitive to the Fed making another mistake. And if they hike, it will be a mistake in my mind. But then I have a much more strategic view of monetary policy. Or alternatively, if credit proves to be a problem.
Do you like this debt deal, Mohamed, or would you have preferred a clean raise?
So I'm not enough of a specialist, honestly, to know which is better.
You never met a Democratic spending bill you didn't like.
You may very well think so, but that's not correct.
Okay,
I was critical.
But now you don't know enough to know whether you rather have a clean bill or what's in this bill. You really don't know what your opinion is on that.
Joe, I have limited time. So my working assumption from day one was this thing was going to get resolved. From what I hear, it's not going to make a material difference to the economic and financial outlook. When we look back, this agreement will not make a material difference to it. What I was much more worried about is non-agreement. So I'm pleased that they have an agreement, but I can't honestly opine as to all the alternative permutations that we could have had, because I'm nowhere near those negotiations.
I mean, do you think the debt is too high as is, and that maybe having some type of restraint over in 2023, 24, and 25, are you for that? Is that a good idea, or you think we ought to keep piling it on?
No, I don't think we should keep on piling it on. I think the best response to a debt issue, and we do have a longer-term debt issue, not an immediate debt issue, but a longer-term debt issue, is economic growth. And my biggest worry is this whole saga has done three things that actually undermine economic growth. One, it has diverted the attention of Congress for weeks.
Keep going.
Two, it has undermined the trust of the American people in our policymaking process. And three, it has sent this wrong signal to the rest of the world about our ability to manage our situation. So I worry, Joe, that growth, which is the answer to many of our problems, is being undermined by this whole process. But I'm really glad that I got to some agreement.